Warren Buffett is worth over $130 billion. He still lives in the same house he bought in 1958 for $31,500. Still eats McDonald's for breakfast almost every morning. Still drives himself to work. Has given away more money than almost any human in history and keeps getting richer. But none of that is the part that should unsettle you. 99% of his entire net worth was built after his 65th birthday. This is not a story about money. This is a story about time, patience, and a way of seeing the world that almost nobody has, but anybody can learn. Great Depression. In Omaha, Nebraska, a stockbroker named Howard Buffett just lost everything his clients had. Into this world, on August 30th, Warren Edward Buffett was born. Most children of the Depression grew up afraid of money. Warren grew up fascinated by it. There is a difference, and that difference is everything. Age 6. He buys 6 packs of Coca-Cola from his grandfather's store for 25 cents and sells individual cans door to door for a nickel each, 20% margin. At age 6, he didn't spend the money. He wrote it in a notebook. Age 11. He buys 3 shares of Citi Service stock at $38. The price drops to $27. His sister glares at him daily. He holds. It recovers to $40. He sells, then watches it climb to $200. He was 11 and already learning the lesson that destroys most investors. Impatience is the enemy of wealth. Age 13, he files his first tax return, deducting his bicycle as a business expense. Age 14, he uses $1,200 from his paper route to buy 40 acres of Nebraska farmland and leases it to a farmer for profit. By 16, he has saved the equivalent of $53,000 in today's money. Here's what most people don't know. Buffett applied to Harvard Business School. Harvard rejected him, so he applied to Columbia, specifically because Benjamin Graham taught there. Graham had written a book called The Intelligent Investor. The idea inside it was almost subversive in its simplicity. Every business has an intrinsic value, what it's actually worth, and the market price fluctuates wildly based on emotion. Sometimes the price falls far below the value. That gap is where you strike. Imagine you know a house is worth $500,000, but the desperate owner will take $250,000 this week. That gap, between price and real value, Graham called the margin of safety. Buffett sat in his class and felt something click that has never come unclicked. Most people learn about money from their parents. Warren Buffett learned from the greatest financial mind of the 20th century, then spent 70 years improving on everything he was taught. Buffett's strategies are not complicated. They don't require algorithms or finance degrees. They require something much rarer: clarity of thinking and the nerve to act on it. Value investing. Not buying cheap stocks. Buying great businesses at prices below what they're actually worth. 1999. The dot-com boom. Every investor in America is getting rich overnight. Buffett buys nothing, not because he ignored tech, but because he couldn't calculate the intrinsic value of companies with no earnings and business models untested by reality. Business Week ran a cover story. "What's wrong, Warren?" His shareholders grew restless. Then 2000 arrived. The NASDAQ lost 78%. $5 trillion evaporated. Buffett was untouched. He didn't predict the crash. He simply refused to play a game whose rules he didn't understand. Compounding. This is the one that makes people's heads explode when they truly grasp it. Buffett uses a snowball rolling down a long hill of wet snow. The snowball is your money. The snow is your returns. The hill is time. $10,000 at 20% annual returns becomes $383,000 in 20 years. $1.5 million in 30 years. $6.7 million in 40 years. The money doesn't grow. It explodes, but only if you never interrupt it. Every panic sell, every withdrawal, every restart breaks the chain. Buffett has held Coca-Cola since 1988. He doesn't just believe in compounding. He protects it like someone who knows exactly what's at stake. Mr. Market. Graham's concept used by Buffett every single day. The stock market is a business partner named Mr. Market who knocks on your door every morning with an offer. Some days he's euphoric and wildly overprices everything. Some days he's terrified and offers bargains at absurd discounts. The insight: you never have to deal with him. You only open the door when his price is irrational in your favor. Most investors do the opposite. Excited when he's excited, panicking when he panics. Buffett reverses it entirely. Be fearful when others are greedy, and greedy when others are fearful. The float, the hidden strategy. Almost nobody talks about this one, and it may matter more than all the others. When Buffett bought insurance companies, culminating in Geico in 1996, he discovered something extraordinary. Insurers collect premiums in January and pay claims in December, or next year, or 5 years from now. That gap, money held between collection and payout, is called the float. Buffett used it as essentially a free loan to fund investments. At its peak, Berkshire's float exceeded $150 billion. He was investing $150 billion that cost him nothing. This single structural insight may be the most important financial engineering decision of the 20th century. Every one of these strategies is simple enough to explain to a child, and complex enough that 99% of Wall Street professionals still cannot execute them. Simple and easy are not the same thing. 3 moments. 3 times the world told Buffett he was wrong. 3 times history proved otherwise. In 1962, Buffett bought into a failing textile company called Berkshire Hathaway. Cheap assets, classic Graham play. The CEO cheated him on a buyback deal one too many times. In anger, Buffett bought enough shares to take control and fired him. Then, he owned a dying textile mill. He spent years trying to save it before pivoting it into a holding company. The cost of those wasted years, capital that could have compounded freely elsewhere, he later estimated at $200 billion in lost opportunity. He called it the worst investment decision of his life. Not because it failed, but because the distraction cost him. The lesson it burned into him: a great company at a fair price beats a cheap company at a great price. Every time. The dot-com silence. 1999. Every investor is getting rich. Buffett does nothing. He is mocked as a dinosaur, a relic, past his prime. Then 2000 arrives. The bubble bursts. Trillions gone. Buffett untouched. 3 times the entire world told Warren Buffett he was wrong. 3 times he was right. Not because he had better information, because he had better thinking. Here is what Buffett actually does every day. He wakes up, reads 4 or 5 newspapers cover to cover, drives himself to the office, drinks cherry Coke, roughly 5 cans daily, reads annual reports, thinks, occasionally makes a phone call that moves markets. He estimates 80% of his working hours are spent reading. When asked how to get smarter, he doesn't say find a mentor. He says, read 500 pages every day. That's how knowledge works. It builds up, like compound interest. For over 60 years, his closest partner was Charlie Munger, who sharpened Buffett's thinking from buying cheap companies to paying fair prices for great ones. Munger died in November 2023 at 99, still sharp, still working. Buffett spoke about him with a grief that made clear the magnitude of what he lost. He has pledged to give away 99% of his entire fortune, the largest philanthropic commitment in human history. He has never owned a yacht, never bought a private island. His Omaha house, bought for $31,500, he once calculated as the 3rd best investment of his life, after Berkshire and his wedding ring. On most days, Warren Buffett does not make a single trade. He reads, he thinks, he waits. The most powerful investor in human history built his fortune not by being the smartest person in the room, but by being the most patient. What does this mean for you? Not as financial advice, as a way of thinking. Buy great things when the price is wrong. Understand what you own. Let time do the work. Never panic. Keep reading. The world will always create noise. People around you will always seem to be winning faster. The temptation to act, to not miss out, it is relentless. Buffett's answer has been the same for 70 years. Check the moat, wait for Mr. Market to be irrational, let the snowball roll, and go back to reading. Someone is sitting in the shade today because someone planted a tree a long time ago. Buffett didn't build $130 billion by being smarter than everyone else. He built it by thinking differently than everyone else. And thinking differently starts the moment you decide to.